I know.
So they'll see.
It's just the way that they do it there.
It's different.
It's so different.
This
This one is the October one, right?
Oh, yeah.
It's not.
Is it this one?
Oh, yeah.
I think it's this one.
Okay, let's close this one.
Yeah,
I used to
I
drive
think it's that one.
down there for the water. On the weekend.
Can we see the title? Use October, yeah, that's it.
Yeah.
Right on A1A. 'cause it was the best.
Wait, was it like,
I hope it didn't just make two.
wait a second.
Yeah, it does.
Was it like, kind of like a long hallway type?
And it was like a guy and they had a slider window too.
Yeah.
Yeah.
It's crazy. It's really good. Well, yeah, that's probably why. 'cause
Slide
my-
master.
This is like my favorite.
Coffee, yeah.
No.
Okay.
See the button there.
That's
Slideshow.
crazy.
Beginning.
Yeah, exactly.
There we go.
Yeah.
We're good.
Because every time I come back down, I ask how we can go, and he's always like, oh, too far. Well, you just make it. Watching him put the amount of sugar in it,
Yeah.
and drink it. When they're doing it, it's different, because I don't see it, so. It's real, it's basically. Yeah.
I'm not gonna be able to walk now.
Try.
It's not recording now, is it? Can they hear me over there?
It is. I'll edit it. Don't worry about it. Hey. I'll go back to the first 5 minutes.
All right.
I don't want, you probably don't wanna go too long.
Okay. Is that good?
Yeah,
Awesome. And I actually have to hit the arrows, right?
yeah.
All right, and back
Yeah,
and
just
forth.
use the forward and back arrow.
Okay. So how can, I guess they can see me and I don't worry about that. How can I get,
I'll verify.
okay. Wow. So are we gonna be able to get Cindy off the screen?
Nope, she'll stay in the corner. You can move her to the bottom corner. But it's just the zoom in will be there.
We can, because everybody's popping up on the screen. Is that not, do we not have the viewers on there?
You wanna be able to see all, see. You're gonna be able to do one thing, see the presentation or see the zoom.
Okay, well, I would like to just see this presentation, but they might be covering things later, but that's okay. We'll work
You
on it.
can, you can drag it, to like put it. And I'll show you. Yeah. I thought she was already in. You can take this.
They may have,
Move it,
okay,
but yeah, because we have to make you the host, that's why.
that's okay, that's okay. I just want to make sure wow, okay, I'm just used to plugging in and then
Mhm,
beyond that, I'm not even sure.
Small person. So if you see.
So here's why I asked.
Other than that, I wouldn't worry about it.
Okay.
That's all it is.
All right.
So after that fun technology journey, we're all set. So I'm gonna hand it over to Lisa, Josh, so we can get started.
Okay.
She is both our sponsor and our presenter today, so she has a lot to share for us.
Yes. Hi, guys. I'm Lisa. I'm with Movement Mortgage. A lot of you guys know me. I know faces, but I don't know names. If it might be introductions off of Facebook, being introduced to the team or something like that. So hi to everyone. Yesterday I hosted a continued ed class with North Carolina Housing Finance Agency, actually teaching about their products. This is going beyond that. This is going deep, but only skipping the surface at the same time. So be patient. I'm just trying to kind of introduce you guys to what it's become in the mortgage industry. And as you guys have learned for your jobs, you basically have to present yourself and sell yourself as a specialist, because it's so much more behind the scenes of real estate and behind the scenes of mortgages. And with mortgages, it's even more like that every day, new products, new pricing, everything. And I want to just kind of introduce you guys to that. For those that do not know me, I've been in the industry for 40 years. I've been with Movement since January of this year, which was a great move. We have a lot more products than what I had with my previous employer of 29 years. So I appreciate the opportunity to kind of come in and cover over that with you. So this is basically, this is our corporate office in around the Fort Mills area of North Carolina, South Carolina. And I just want to let you guys see that this is our corporate office just down the street from us. It's really, it's a nice facility, and air is not working.
Put the PowerPoint. And then click it.
Click the PowerPoint.
Yeah.
And then click. Oh, I'll just use this right here. I'm familiar with this little area.
Oh.
Okay. So basically, this is behind the scenes, and this is how crazy it has gotten in the mortgage industry. I mean, it's like, oh my gosh, we have a new product. What does that mean? You know, and we're digging deep, and you can see more numbers, more numbers. And so then, as your loan officer, oops, there it goes again. Why isn't it doing it? Okay. I am convinced I'm going to find the right deal for your customer that fits their needs best, because a happy seller, happy realtor is happy loan officer, as well as buyer. But I'm trying to do this, and she's supposed to be kind of smiling, but I guess at one point in time, that's kind of the way I am. The reason I chose this picture is it is so much about the area that your buyer is buying. More, just as much so as it is the customer itself. And so those maps, I'm constantly, where's this house located? What census tract am I in? What county am I in? It really has gotten very deep into that. So that's the reason I kind of chose this picture, trying to be comical, but at the same time, kind of introducing you to how it is. Okay. I'm gonna have to tap if I hit the right button. I went backwards, sorry about that. I'm used to the little clicker, but I will adjust. So this is where we are. This is an idea of what we are in today. The median income is 73,000. For the average family is 73,000.
But in the state or the?
That's just kind of in the country, so to speak. It's trying to just do it, and this is an age group of 30 to 35. The median total finances for this particular, for anyone, a first-time homebuyer, is like 13,900. Their debt load is 65, and their median payment on debt alone is 953. So it basically comes down to, will it work for this customer? So if we take the 73,000, their monthly income is 6,083. This particular product, there's a 55% of their debt and their house payment or their income for debt to income ratio. So we've got their calculation of their debt to income ratio maximum. We subtract out the 953. We get an amount of 2,392 that's left remaining that they can qualify for housing. The average house price is 400,000 in the area. Then you come up with the standard FHA, because this is an FHA-based product that's that is a cheap mortgage product. And we come out with FHA, and basically the PTI for this particular house is 31,000. We have a problem. We have a 67% loan to value. I mean, 67% debt to income ratio. I get nervous when the things don't connect first, so let me just get that out of my. So anyway, we did not have a qualified borrower. So what are we going to do? And this is happening more and more and more every day. I was just telling Justin, I was like, Justin, have you sold your Nash County properties? I mean, it's something that we're having to go to Nash County for affordable housing in what used to be. I mean, when I was when I started in the industry as an originator, a first-time homebuyer was buying a $125,000 house. We won't even ask what a $125,000 house would buy you now. You can't even buy most vehicles, much less underneath that. So I guess we all living in our home if we don't find something different. So let me define AMI, because we use that term all the time in my world. And AMI is basically the key metrics used for affordable housing financing and program. It represents the median income level of a specific geographic area, which can include cities, counties, and metropolitan areas. This drives interest rates, it drives down payments, it drives loan programs. It is a lot. This right here, this is AMI. So this is our state. We started out with Wake County, then we added Johnston County. I'm talking about growth patterns. And then all of a sudden, look, guys, here we go. To buy affordable housing, how many counties are we having to add for our clients to find affordable housing? 12 counties. 12 counties that when, as your loan officer for your customer, there are times that I'm having to compare what can that customer buy with a loan product. Oh my goodness, we left Wake County, we left Johnston County. Think the lower Johnston Wake basically has the same income limitations, sales price limitations, and so forth. So crossing over those, but all of a sudden, I jump over here, I'm in Sampson County. Your borrower has said, well, I can't afford Wake and Johnston any longer. Let me go to Harnett County. Harnett County is here somewhere, but these incomes vary from $30,000. And in some programs that when I'm going from 100%, this is 100%, and some programs when I go to 80%, my customer that could have been making 97,000 to qualify now can only make $58,000 to qualify for that specific loan product. So when we cross over these counties, I literally am saying to your customer, let me know what counties you feel that we're going to be talking or looking in. And the same thing with you as an agent. What county do you think we're going to end up having to go in? I need to know that a little bit up front because with some of the programs behind the scenes, my sales price limitations are also going to drop from 490 to 385 to 257. And that's the same borrower trying to buy the same price. And then all of a sudden our prices change, my loan product changes, and the interest rates change.
Lisa, do you have that right there, like in a handout? You can like
Absolutely,
or an
email it to
email?
you.
Yeah, please do. That's a great snapshot.
Oh, good. I'll be glad to, and I can do a co-marketing with you guys. So it has both of our names on it,
Mhm.
okay? So we've got the 3.5, we have the 3.5 that you can do FHA, because you're medium income of it's credit score of 580. We have the 3 to 5% down conventional, medium is 620. We have the 0 down, which is USDA. We have the FHA down to 580. And then we had the movement boost. I haven't talked a lot about movement boost. That is our product. We have 2 products I'm introducing to you today. And that's 0, that's going to be your 0 down payment.
Can you get them on manufactured,
Yes,
conventional? Is it a conventional?
it's got this product, movement boost is FHA.
It's FHA, okay.
Mhm. But I can do it. So. Sorry,
Can you
guys.
speak on that real quick, if you have a moment, like FHA for manufactured, what would be required?
Oh, it's pretty soon. It's a lot.
Okay, well,
But
Well, like
FHA,
structural engineer letter,
we're gonna have to have a structural engineer. We're gonna have to have the letter,
HUD labels.
the HUD labels. We had, it can only be, I think the built out is beyond 1978. I don't know if
Yeah.
it's been pushed out further because if you
Okay.
think 1978 is a lot longer than it was when they set that year.
Mhm.
So there are very.
checking with you, like what would need to make sure it checks all the boxes.
Correct, correct. And then when we get to certain areas, like when I was looking at different counties with an agent for their buyers, we literally had been on, I've been on realtor.com, or she sent me over several listings and I'm like, this is a price, but now to meet the price for this customer, I'm seeing, are these roads private around this property? Is it street? I mean, it's really digs deep when we're really getting into the affordable housing.
Mhm.
But affordable housing now is now up to 490, 500 houses. So at the same token, that is a broad definition. I mean, it is just such a broad definition. And anything that you guys see on the screen, I can get you, have marked it with you and so forth as well. So I'm not going to hit North Carolina housing, but I'm going to hit the highlights because that was a 4-hour class like yesterday. And it's awesome. If you guys can ever attend one of North Carolina housing's training that they're teaching, it's excellent, but it is 4 hours, but it's very good. So North Carolina housing has the $15,000 down payment. The maximum sales price is $490 for this $15,000 down payment. Each income limitation is based upon counties. Okay, so again, we cross over, my 15,000 may no longer be available to that customer but this maximum sales price is the $490. Then we go down to their 3% down program. Their 3% down program can be used for, and that's 3% of the loan amount. I can use that for conventional FHA, VA, and USDA. So if you have a house of 400,000, it could be a possibly up to or close to $12,000 for the down payment systems. That can be used on manufactured housing. Okay, this 3% down, because I can use it with FHA and different ones. I can also use this 3% down for an individual buying a duplex that's going to be occupying one unit. Okay, so you've got 2 units. A lot of these programs will not allow a 2-unit property, but I can use this with FHA and they can buy it and rent out the second unit. That's amazing. If you can find a duplex in this area now. I might have one for sale later. But just to let you know, so think of this. I'm not expecting you guys to remember this because guys, my will just spend some days with everything that I need to put together for individuals. I'm introducing you to it. Okay. So then we have the community partners, and this is up to 25% of the sales price, maximum $50,000 down payment. I can combine this with a 15,000. Now I just combined 2 loan programs. One loan program has one income limitation. Another loan program has another income limitation. My DTIs are different, but I can layer them. This money, I'm working with a customer now trying to find them a house. We just found out they ran out of money until January. But they expect us to be back. We'll have more money back in January. Don't know how much it'll be, but it will be. Yes, sir.
So when do we, if we have somebody that's like, I need to buy a house, I have no money, but I have good credit, then we send them to you for this.
You send them to me. Because there might be a time that their credit score, or I might have other products, we don't need to use all of it.
Do they just have to pay closing costs though still, like?
They're still gonna have that 3% can be used towards down payment, closing costs, whatever. So if they're a veteran, they may still want to do the 3% just so they can get their down payment and closing costs or pay their buyer company.
So literally they could bring nothing to closing, essentially.
Especially
But
if we
they
find
need
them
to still use
something.
nurse like for it.
Yeah, they're gonna have to have the money up front.
Yeah.
But that goes towards the bottom line.
Correct.
And if we're even shopping this product, we probably are shopping somewhere where we're able to get away with like maybe 1% DD
Right,
typically.
right,
Um,
exactly.
Okay.
And that's what's so important too, but this is basically introduction because it is so many things I look at to give your customer the best rate, the best PMI cost. Should I go FHA? Should I go conventional? Why should I do these things? What does it mean to your customer's bottom line? Not only in payment, but long-term financing, because we may not be able to refinance right away. And I'll hit on some of those comments of subject matter as well. But it's just so much to it. The best thing to do is get them to me before they even start shopping. The first question I ask is, have you already started looking into a house? Because a lot of times they've already been looking online. They already know, oh, I love that house. It's 400. They may only qualify for 3. So I need to know where they are. I like to be able to talk to them in advance of them even starting to look, because then that way we could already know they could start eliminating some areas. And if we need to be in Nash County or I need to be in Harnett County, I'm going to start eliminating products. You know what I'm saying? So it's kind of like, as I was working with a customer now, I said, I'd love to, let me work up your numbers. I worked up 9 scenarios for this customer and I presented 3. I said, but it really depends on where you buy. Because you're trying to be, she's trying to be in Durham, but she may end up in Chatham County, or she may have, all the counties right in our triangle area, change over very easily. But this is just an introduction, okay? Because we could talk 4 hours about North Carolina housing. And not meaning to skip over, but the main thing is, in order for me, I am not a loan officer that you're going to say, my customer wants a 30-year fixed rate, unless they have the 50% down, 20, and just credit score. Most individuals need me to dig deep into it and just see what I can actually offer them. It's literally becoming a specialist and not just your loan officer. So another thing before we get into Boost, all loans have a loan level pricing adjustment. on our conventional and even on FHA to a certain point, but mainly on conventional. That means what is my loan amount? It's going to get an adjustment due to the loan amount. It's going to get an adjustment due to my down payment. It's going to get an adjustment due to the location of the property. It's going to get an adjustment due to their credit score. It literally is loan level pricing. And so for each customer, like this morning, I was working with a customer and I was like, okay, she would really like to borrow this much money. But as soon as I put her on that, as soon as I increased her loan amount, $6,000, she had to bring 1% more down to closing. Because it literally took me over a loan amount that then is its pricing. So it's behind the scenes. So we call that loan level pricing adjuster, and it is big. And you need, and I know a lot of loan officers and they're all awesome, but I'm gonna mention to you too, some may not be digging this deep for your customers to make sure that they're getting the better pricing. And then you're trying to negotiate a contract for your, or for your seller accepting contracts. And I may know that that particular house you have listed has special pricing available, but another loan officer may not dig that deep for it. So, I mean, it's just, it's gotten to a, I feel like I left the world of loan officer and became the specialist that's looking for everything. So our movement boost, and this is really so big to builders, by the way. Builders really like this program because there is least restriction so far as income limitations and things like that. But at the same time, if you're asking for a lot, you're not going to get the lowest rate. And that's just reality. When you're asking for down payment assistance and you're asking for a lot of different things, you're not necessarily going to get the lowest rate. This is a FHA product, manufactured housing eligible for 1 unit only. I've never seen a 2-unit manufactured, but we won't go there. I have heard of manufactured condos. But the credit score is 640, okay? On this is a 30-year fixed FHA. There is a second. I can do a 3.5% of the sales price or 5% of the sales price. I highly recommend the 5% because we can use part of it, 3.5%, to do the down payment, and that leaves me 1.5% of your sales price to be paying on closing costs for the customer. So then there is a payment on this one. You've got the lien is going to be 2% higher than your note rate on your first mortgage. It's a 10-year payback on that with 2% higher. So if your interest rate, and this rate is not going to be the lowest rate because again, we're offering a high risk loan that we're shelving ourselves. So then you have, you're going to have a higher rate, but then your second is going to be a payback. And that's going to have to be considered in their payment. That payment on average would be about $150 to $170 on the average $350,000 to $400,000 house. The loan amounts will go up to FHA maximum. So here's your customers that are in the higher price points. And then your income limitations, it's 160% of the AMI. The AMI in Wake County is 122. So if I do 160, my customer can almost make $200,000 and get down payment assistance. What program is going to allow you to do that? Okay, so just know that. But if they need that money and they're making almost 200,000, the rate's going to be higher. They are going to have to pay back on the second, but they got into a house, and that's what our goal is. So it's not limited to first-time home buyers. Yay. Okay. My debt to income ratio, 56.99%.
Great.
Okay. Now that doesn't leave them a whole lot of money to live off of, depending on how much of the house is that, but it does allow that. Now I'm going to say up to, because if I have someone with a lower credit score and I have different scenarios, we may not be willing to go quite that high on everything, but this is FHA product based. Okay. Non-occupying co-borrowers are allowed. You don't get that on other down payment assistance. Non-occupying co-borrowers are allowed. The maximum loan to value is going to be 96 on my first, and then my second is going to put it to about 105% combined LTV. Manual underwrite is an option. That means if I do not get an automatic decision, we call it AUS. I'm going to start using acronyms, but that's our automatic decision. If I do not get that, but I can do manual underwrite, I'm not going to be able to go at 56 on a manual underwrite. I'm going to be closer to the underwriting guidelines. They're like 41, 45, and then so forth, like that on the back end. but it is an option. Not all down payment assistance programs allow a manual underwrite. If you do not get an online approval, you're not going to be able to take it that way. This program does. 1 to 2 units are eligible, and there is going to be an origination fee. We don't normally charge origination fees, but there is on this product because it's
Good.
an all put together product. Okay,
So
so
what's the catch?
What's the,
The higher.
okay?
The higher rate?
The higher rate and the second mortgage being a payment on the second mortgage.
Continue.
the restrictions on refinancing?
There are some, okay? Now, I want to go back to that because I'm going to be talking about that with other products as well, but
Yeah.
if you'll table it in just a second. This is our other product that we just came out with, Dream to Own 4% down payment. This is our conventional product. Basically a minimum of 3% down. My minimum loan to value, in case they don't want just the 3% down payment, but they have to have an 80.09. They can only put out a 19% loan to value. We have to keep PMI required on this product. The minimum score is 660. The debt to income ratio with the approval, online approval, will go up to 50. And then the MI is required. You got 80% loan to value. AMI, excuse me, all my acronyms are crossing over. We got 80% AMI for Wake County and Johnson County. That's 97,000. And then the mortgage mortgage credit certificate is allowed on this. North Carolina housing, that $15,000 down payment, you cannot use mortgage credit certificate. And I'm going to hit on that real briefly later. The down payment assistance is going to be up to 4% as your second mortgage. The second lien is going to be the same interest rate as your first lien interest rate. That's good. Interest only payment. Your average payment on a 400,000 would be approximately $80 to $85, interest only. And that's part of qualifying. And then it says maybe this rate too, keep in mind, North Carolina housing, they have excellent rates because they do not use the person's credit score. I mean, if you have a client at 640 on conventional and I price out their loan, their rates are going to be 7.5, 7 3/4 and so forth with a lot of minimum down payment. With North Carolina housing, they don't use that. So their rates are going to be a little bit better. But the one thing about it is that is their rate. You cannot buy it down. This rate can be bought down. So if you have a seller, and I'll go over some scenarios later as well, and it's not limited to first-time home buyers. Okay, so this is comparing. This is just a real brief, in case you always want to do a screenshot. North Carolina housing has a one rate option. You've got the 15,000. Ours on our boost and our Dream to Own is 3.5% to 5%. This is your payment scenario, which we just kind of hit on the other screen. This is just a summary of it. This is your Dream to Own, and this is the movement boost. And again, there's builders in Texas that are using this movement boost like crazy. We just got to introduce it to our builders here as well. But so it's new construction existing. Then we go over where North Carolina housing's the 45. We're up to 56 and up to 50. Income limitations per county for the 15,000 and the qualifying income for the 3%. So when we say qualifying income, it's their income that they're using for qualifying. If they're married and they make 250,000, but the person can qualify and meet income limitations, we're fine. It's not household on some of the products that they have. Some it is household. Sales price limitations for the 15,000 is 490. We do not have any sales price limitations on our boost. It's just going to be the maximum loan allowed for FHA or convention. And then we have the conventional and the mortgage insurance per product. So it's going to be their insurance per product. Like FHA has our upfront of 1.75 and then the 0.55 and so forth. The one thing about my Dream to Own is if they have a high credit score, their PMI may be as low as $75 to $90 a month. Whereas if I go FHA, it's going to be more than that. So that's where knowing what their income is and locations and what program I'm going to use. Minimum credit score on North Carolina housing is 640, 600, 660. I'm just wanting to kind of give you a quick view on that. All right. So here we are. We had the customer that, let's recommend the movement mortgage to that customer that had a 67% back-end ratio that was not going to be qualifying. So we're using the 5% down portion. We're going to use, they had $13,900. We're going to use $4,650, pay off the balance on a car that the payment was $600. Now, for you guys, you may think, well, if the payment was $600 and the balance was here for $4,650, we wouldn't count that payment. That's true in some cases, but FHA says if the payment is more than 5% of their gross income, you're going to have to pay off the debt. So that's the reason in this scenario that debt had to be paid off. We brought their debt level from 953 to 353. And that left them 3 months in reserves, and we're not wiping their money out. And then the builder, in this scenario, the builder was saying 3% in closing cost on a 400,000. We used, because we used the 5% for down payment and to pay off the car, it gave them a better mortgage insurance because FHA now is giving a lower mortgage insurance with, a higher down payment. We were able to get that rate down to 5.75 on that particular day that this screen was made, okay? Because this is, when I send out information to you guys and I say explore financing options, or let's talk about what to use for these incentives that the builders are offering and so forth, this is one of those scenarios. Is it all about buying down the rate where we could use the customer's money, pay off more debt? We just freed up $600 of their money versus putting it in the house or putting it toward discount points. But we also were able to use the builder's money to buy down the rate for them. So we ended up getting their debt to income ratio, 56.9, they got into the house. So this is just a scenario. So before I go here, I'm stand in front of the screen because you guys are like me, I have to read ahead, but anyway. I want to go back to your answers about the refi. So there's a lot of programs, the 15,000 and even the 3% and so forth. The 15,000 down payment assistance, oops. Okay, the 15,000 down payment assistance from North Carolina Housing would have to be paid off with a refi in the first 7 years. Okay, so that means that you're rolling in the first mortgage of 290 plus the 15,000, and they're going to have to start making a payment on that 15,000. Okay, so, and that would have to be a rate term. We'd have to make sure that the house appreciated enough to be able to roll that in. After 7 years, then you can do North Carolina Housing would subordinate that 15,000, and you're only refinancing that first mortgage. But it still would be a rate term because you're paying off a second mortgage that was used for a purchase. If you do a cash out refi after the fact and you're paying off a second mortgage, it becomes cash out and it's a higher rate. Okay. That's North Carolina Housing on the 15,000. On the 3% down for North Carolina Housing, you'd also have to pay it off. On our boost, a 3.5% and 5%, our 3.5% down after 3 years, and our 5% down after 60 months, 5 years. Okay. So your thoughts are, oh my gosh, they got into the house, the rate's higher because of the loan program. Now we're going to refi. Well, the only thing is they may not have gotten into the house. And every $10,000 on the average interest rate is $67 a month. So you're basically saying that if they had to roll in that second mortgage and put it into the loan, they may be only increasing their payment $90 a month. But yet they got a much less payment and they're saving over $300 on the first mortgage. So indirectly, it's not such a bad thing. But you have to look at the banks that are offering that second mortgages. We're not making a lot of money. You're not collecting fees on the 15,000. We're not collecting fees on if it's 20,000 or whatever. So we literally have to make some money in order to loan out that money. And so that's the reason they kindly indicated it, set it up that way. But at the same time, if the houses are appreciating, after 12 months, we're going to consider that appreciated value of the property. Not during the first, it has to be 12 months from the date of closing. We use the appreciated value. So they may end up coming out with a better loan program, have enough equity to combine them both, and then also get rid of private mortgage insurance or have a lower private insurance factor. So that, I don't consider that a downfall. Now, when I have a customer and it's the scenario of, do I want to use MCC or do I want to use the 15,000? Because North Carolina housing, you cannot combine those two products. And so how do I cancel my customer? You're not going to be able to refinance this because that 15,000 for North Carolina housing is forgivable after 15 years. At 11 years, we start cutting off 20% of that balance, okay? The only thing is, are they going to be in the house for 15 years? So when they sell the house, they're going to be paying off the balance anyway. It's not free money. It's not a grant. And that's one thing North Carolina Housing was pointing out yesterday. These are not grants. They have to be paid off. These are not grants. So they're going to be paying off the second mortgage anyway if they sell, because most individuals are not going to be in the house for even 11 years or 15 years. So think of it that way. And the other thing is being able to possibly get the lower interest rate and combine them all. But don't think of it, oh, this 15,000 is forgivable. Well, it's a long time before it's forgivable. And North Carolina Housing says, we can't forgive it. We've loaned out 15,000. We're not collecting any interest. And on our program, on one of our programs, we're only collecting the interest only. And they're not going to have, and they're going to still have the full balance if they're not paying it off. Make sense? And then with my customer, I said I can either do mortgage credit certificate. I'll go over more of the details of that benefit, or you can have your 15,000. 15,000 is going to lift you $2,000 in the bank. With the 15,000, he only had to bring $2,000 to close it. So he was like, I'd rather have the money, even if I can't refinance and have it subordinated, because if the rates really improve, I'm just going to refinance the whole thing. That answer the question? Do you see how complex all of? Yeah.
Yeah.
You see how complex this all gets? I mean, it's just literally, I wish I had all the answers so quickly. Okay, so this is our community lending program. And literally, it's amazing. This is where the loan level pricing adjusters really come into play. This is a conforming, and that we don't need to worry about, these are our terms. It's for a purchase, no cash out, and a cash out refinance. I can use this product for refi and cash out and purchases, okay? Loan to value is 97, minimum credit score is 620, 1 to 4 units, purchase only, primary only. And I just need to make sure that the property is located in the right area, right metropolitan, right census tract, so forth. And it's not a map I can easily say, oh, we are here and here and here and here, but it doesn't zoom in. I will tell you that parts of Johnston County borderline right there at, I guess, Gardner and Clayton, I think it's a 27610 area code or something, or zip code. And that's considered, it shows on my map that it's right on one side of 70, close to Clayton. So there's a lot of houses there. 27604, a lot of houses, Nightdale area, a lot of houses. But where it helps me for my customers is when I have loan amount at sales price at 350, 300, loan amount under 300, your customer is paying a lot more money in interest rate. This program, if it's located in an area, a census tract area, I don't have all that pricing adjustment. I had one customer, and I might be skipping ahead. I have one customer, and she's been looking at so many houses. And every time, and for your customers, I'll be glad to do this too. If they have a list of properties that they want to go see, and there's a few that they are really, really interested in, please send me the listing, and I will try and already have a plan of what a program may be for them. I'll already be doing my background search of where that house is, what product I can offer to to that customer, and I will let them know what their payment estimated is before they go look at the house. And one of the customers is like, this has been so helpful because they already know that, oh, but it's not gonna, but it could be, but let's see if this down payment assistance is here or whatever. And one customer, every time she goes to look at a house now, she sends it to me. She goes, you have no idea how much this is helping me, Lisa, because I already know that when I'm walking in the house, I can afford this house. And this is my payment on this house. And of course, it's going to be tweaked a little bit, but it gives them an idea. So the reason we want to do this is that the lower end loan amounts, I literally had this particular customer, I didn't tell her, I just said there might be some special financing, but I didn't want her to pick her dream home based upon this little criteria. So one house she selected on that particular date, the interest rate was 0.875% less just because of where the house was located. Same price point we've been looking at, just the location. And it was that and the rate or the same rate and saved them $3,800. So for me to say, I don't have the grants that some of the banks have at 5,000 and so forth, is in this little large area. But right here, I could have offered the same rate and given the customer $3,800 at closing. So that's where we really dig deep for your customer. Okay, mortgage credit certificate. Is anyone familiar with that? Okay, mortgage credit certificate. How? 4 hours of training. So mortgage credit certificate is literally a tax credit that is throughout the up to $2,000, and that's based upon the interest that they paid on the house. And so therefore, in other words, their federal income tax withholdings is reduced by up to $2,000 per year. Okay, that's $167 per month. They can change their W-4 with their employer in order to bring home that money on a monthly basis, or they can wait until they file their taxes. And if they owed 5, they may end up owing just 3. Okay, but it is a federal tax withholding. There are income limitations and sales price limitation. 490 is the sales price limitation. The income limitations vary per county. Okay. So this can continue for the life of the loan. There's some products I cannot use it with, and most of our products I can use it with. So therefore, if they are in the house for 10 years, that's $20,000 they saved in federal tax. That's huge. And it will continue for the life of the loan. If they do a loan program, and I've combined it, and they refinance, they can transfer this over with the refinance. It's the borrower's responsibility. It's not your responsibility. It's not my responsibility. It is their responsibility. They will go through housing. They will give housing the difference in the changes. And then they are able to claim that whatever the credit is at that particular time, because if they drop their interest rate, that could either go away or be lower. Okay, because it is based upon it. So what does that mean to your customer? And this is where do we really need to negotiate for a seller to pay down points that they may end up not using them all if they do the refinance or so forth. So what does this $2,000 mean? It's $167 a month. So there's not going to be subtracted off their payment. It is literally going to be their household budget has just increased or improved by $167 a month. What does that mean to them? That's $25,000 in sales price. So right there, when you've got a customer that I just cannot go over this sales price, I cannot go over this, I cannot qualify for this. It basically equates to $25,000 in sales price if they're able to qualify for the full amount. Not even negotiating. Do you see where I'm going with this? And then on the point, it's a 0.625% reduction in the effective net of the housing expense and rate. You see where I'm going? So it gets complicated to explain it to a customer, but they're bringing home $167 a month. So this, of course, then the tax credit may be claimed monthly or with the W-4, and it may be transferred on a refi. Okay. Now, the reason you may not have heard about it a lot is because when the interest rates were so low, that 30% of the interest may not have really been helpful. And then when they changed over to having the standard deduction of 12,500, and I don't know exactly for single and maybe married couples, 25,000, to be able to write off interest didn't always end up being 25,000. So this might be a little bit more for your single, but that's where I come into play. That's where I come into play, and I'm going to ask for their tax returns. I need to see what they paid in federal income tax and so forth to see if this product will be good for them. That's where the pre-canceling starts early, because in that way, when you're out trying to negotiate. And that is overlooked so much. When I was originating in 87 and in the 90s, I was known as the first time homebuyer queen. And I don't mind being the queen, but I want to be the king. I want those jumbos, I want the new construction, I want, the second homes, the beach houses, all of that too, because I have a lot of knowledge with that. But I'm also passionate about working with individuals to try and get them the best loan for what they're trying to achieve. Okay, so this may not be affordable housing, but we just had luxury homes that are now more affordable to your customer. Movement is already offering the increase in the conventional loan limit. Right now it's $766,550. We're already offering what is being proposed for 2025. This is huge. This means that your buyer may be able to get into that luxury home with 3% down. It means that first-time home buyer for the 3% down. Your buyer may be able to get into this luxury home with just 5% down and not be in jumbo. Jumbo, when you get into jumbo, a lot of times the rates they could be better, they could be worse, but underwriting guidelines get a little more strict with jumbo, the residuals of what's needed after closing and so forth. But I just wanted to mention it. So even though this is not affordable housing, it is affordable housing if someone wants luxury prices, because we're immediately offering this to put it back to jumbo. So I worked up so many different numbers, but I thought today is not the day for that, but I thought that would be helpful.
Would they change based on VA? Is there like a different number for VA?
No, VA is going to be the 802, but VA, that's just the base. VA, as long as we can show that the client has 25% guarantee, that our loan is covered by 20% guarantee, they could buy a 1.1 or $1.2 million house with zero down payment. Okay. And VA, so I'm pretty astute with VA, so I'll be glad to help your VA customers as well. I've given this out several times, but this is your seller concession. This is how it breaks down per loan and so forth. And that is so important now more than ever because of buyer's compensation. Okay, so, and we know that the buyer's compensation isn't part of the seller's concession for underwriting. But we also know that if the seller concessions are $18,000, $20,000 on the contract, I'm going to need a little bit more to show me that it is going to be paying the compensation. Otherwise, I'm over my limits, conventional or so forth. Yes.
So we can write an offer, the seller's not paying compensation, but we write an offer, and then in that offer, the sellers agree on 8% of compensation. Let's say for FHA, they agree to 8% of seller concessions. After we go under contract, we're like, okay, we're using 3% of those concessions for buyer agency compensation, 5% for the buyer. We can have them sign a 220 that says 3% because we agreed upon those overall concessions, and then it's not messing up the loan, it's only 5% because the compensation isn't seller concessions.
Okay. Your 220 is between you and your buyer, correct? Or what, or which one is between the seller? No, but you're also saying you're getting the 220 that the seller's, the 220 and the seller is paying the 3% through compensation. And it is written in that 220 form. Is that what you're saying?
It's between the seller
Yeah,
and the buyer, pretty much.
yeah, that's
Not
cooperative.
Right, it's true, but that document is saying that 3% is going to compensation. So then when you're writing your contract, that 3% isn't in your concession line, correct?
No, it's on the 220.
Right, it's on the
It doesn't
220.
go in as part of the contract unless it's being negotiated after the fact, the seller has not signed the 220.
Okay,
Prior
then
to
you're going,
listing.
okay,
So
so
in that case, wouldn't you just at that point do a 220, like during that period?
You could.
Do a
you
separate?
could, but, because I'm glad you asked the question. I'm not a realtor, I'm not a realtor commissioner, whatever, okay? But this is how I worked it out in one of my deals. The seller, and there are certain companies that are selling houses, buying and then reselling houses, no names mentioned. And they do not want in any documentation format or anything that they're paying anything towards compensation. Okay,
Okay.
yet they will pay over the 3%, 6%, or whatever my limitation is for my loan on the contract and seller concessions.
Yeah.
My underwriting is going to look, well, yes, it's over. Mine was conditional with minimum down, so it's 3%. So my compensation was 18,000. It was over my 3%. But I knew that so much of it was going towards compensation, but that seller did not want to sign anything related to the 220
That's good.
that earmarks it, that it was going towards the compensation. Why? I don't know.
Right.
Your individuals may be fine with it. The way we worked around that is you have a 770G form.
Yeah.
Mhm.
Okay, your 770G form, if you will have it filled out because it's between you and the buyer,
Mhm.
okay?
That part of that is going
Correct.
to you.
And it's going to,
We have
it
that.
has to be very specific though for underwriting, and it
Yeah.
has to say the 3% seller, 3% compensation is coming out of the $18,000 seller's
Mhm.
concession for property as per contract. So
Mhm.
you have to reference the contract, because most of your sellers that have agreed that they don't want to pay compensation, and you're going back and negotiating compensation. For some reason, they're not wanting to be associated to that, but they don't mind, hiking up the concession amount. They're still willing to pay it, but they don't, something about saying I paid compensation. I don't know. But a lot of that is.
Well, and a lot of
more
times during
companies say
negotiations,
concession.
when you're asking for concessions, it's none of their business what you're asking them for.
Correct, and that's your
Right.
typical.
So, yeah, so a lot of times the seller's like, no, I'm not gonna do it, but I'll give concessions, and you agree with your buyer, then you just found your way around it.
So, but from underwriting standpoint, all we have is that we have just what you've agreed between you and the buyer.
Right.
But we don't know who's, because by law, they pay you however they want to pay you.
Right.
Is my understanding. So that was our way of doing the 770G form. And because otherwise they were saying, well, we need a contract addendum between the buyer and the seller. I said, well, the seller wasn't wanting to use the term compensation on anything. And so that's the reason that's the form we used, and we just mentioned the contract, per the original contract, blah, blah, blah,
Right.
and that's how we got around the underwriting part of it.
And so we can be over this, if we have to, for some reason, there's not an agreement of compensation, and we have to get they need all 6% in seller concessions, but then they need however much more.
Yes.
Based on the agreement with the realtor, and the contract says 9% of concessions. But after we go on the contract, we start to delegate where
Yes.
those, and all they need to see is like, oh, 6% for everything else, 3%, so.
Right.
So then it gets.
I just need that the
The
770G form, but it has to spell it out specifically, and I think you only have so many coordinates to put all that information in, so you may have to like add a additional text or something.
Yeah, there's an other box on.
There's so, but that's the way it is, because for underwriting, we still have to meet Fannie Mae Freddie Mac guidelines, and
Yeah.
Fannie Mae Freddie Mac guidelines read in a contract,
Uh-huh.
there's nothing in there that is saying that it's going towards the compensation.
Uh-huh.
And your agreement, that 220, the way underwriting is looking at it, that's between you and the buyer. So this is saying,
From the seller though, is he has to sign it. The seller has to also sign the form.
if he's agreeing to pay it.
Right.
And if he agrees to pay it, it's compensation, we're okay.
Right. Then
Because you're
everybody
not
comes-
putting it into your contract.
Right, it's
You're not,
separate.
that's
addendum.
separate, but when
Yeah.
it's not in the contract, and it's in when it's not on there and it's in your contract numbers, if you're not breaking it down to that 220, I am gonna need the 770G, and you just fill it out for me.
Yeah.
So
That's,
question
That's
for
fine.
like the affordable housing client, like, I have to say for my own clients, like it throwing in like 2 or 3% in conversation to them in terms of getting the BAA signed seems a little daunting for them. Has anybody had any strategies for kind of like getting them to come on board with there's now the question of the seller may or may not actually be coming up with that portion for you.
I am working on trying to, and I've seen it, but I've got to figure out how I'm gonna do it and make it easy. But my goal is to work with you guys to say, here's my sales price, seller's paying 3%. Paying my commission, no worries. Here's my sales price, the seller's not gonna pay anything. And I'm gonna have to increase your sales price. And you'll have to pay it through and negotiate it with the seller through that amount by increasing the sales price. Or you're gonna have to put less money down and to pay your compensation. So your down payment may not be as much, but if you're working with affordable housing, that's gonna make it more difficult. Or I'm gonna pay a higher interest rate and the lender's gonna pay part of the closing cost. I'm trying to work that up where you guys can kind of, if it's nothing else, it gives you an example of it, but I really want to try and work it up, that it's a worksheet where you guys can go in and do
Yeah,
it.
it hasn't really been that big of a deal yet.
It hasn't been for us either until,
I mean, I have
It
all
was
my
a
buyers
business.
signing it at 3% and explaining to them exactly that, but telling them, I mean, for the most part, like, it has not been that big of an issue. One, two, it's my job by you signing this, that I'm gonna do whatever it takes to get what you need to go to closing.
right,
So we're gonna figure it out, but I'm not gonna not show houses based on.
absolutely, absolutely.
And I feel it really, most of the listing agents have been doing a good job of having that
Absolutely.
conversation.
And honestly, when I got this particular one, I just always try to think ahead. Like, I may say this looks great, and I may know that these are our selling concessions.
Absolutely know what they're up
Right,
against.
but at the same time, let's see. At the same time, I need to think about how underwriting's gonna look at it, and then to
Mhm.
try and say, okay, Mr. Seller, you went here, but it's not broken down and where that money's coming from the seller. I didn't want to go back and ask for a contract addendum because he's already been very blatant that his money wasn't gonna get towards compensation. I didn't quite get it. He still paid it, so,
Right.
but whatever. So that's the way we were working around it with the underwriting. And I had been one of the first ones since August changes had received that. And that's the way we were trying to get around it. But, Fannie Mae, Freddie Mac may go, nah, we're gonna need a contract addendum. And we were just trying to keep it simple, where we didn't have to get back to the seller to get
Yeah.
anything else from them. So, but I agree with you. I haven't heard of any other issues. It's expected. I wonder at which point that it may be where it becomes a little different. And why I want this, oops.
Well, I'll tell you that I had a seller want to pull their offer of compensation. And I explained to them simply why I didn't think that was a good idea.
Right,
And it's a great negotiating tool, and he came back around.
right.
So I feel like it's like, yes, we may see it, but I feel like we're gonna see it less than what we'll see. Just as what
Absolutely.
has always operated.
Absolutely.
Yeah,
And we agree with
We saw it
everyone.
before.
We've only seen it with, businesses that are buying, flipping and selling. And there's just something about,
Like open door,
Mm-hmm.
I'll say it.
I didn't, it's a business. I guess they're trying to keep what their bottom line, what their cost accounting. Right. All right, guys. So one of the other things that is becoming so important to your customers, I am not an insurance agent. But insurance has done nothing except go up. It's up 15%. So when I'm working, and it's gonna probably continue to go up because it has for years. So, and this is just showing you the different price points of how much insurance has gone up. Well, I'm estimating on average, I was using maybe $960 a month in insurance, whatever on the average affordable housing. I'm seeing homeowners insurance premiums at $1,200 to $2,000 on certain price points. And I've used a lower income. So the one thing is we need to teach our customers when they're talking to their insurance agent, and it could be that you might need to start letting them really shop insurance companies as well. I recently had a customer that says, what am I going to do? And I'm getting this quote and I can't give any explanations. And so I gave her 3 and we were able to get it down $500. So, and I'm not an insurance company and I'm so forth that I can't imagine what their expenses are in the background. But the one thing is, my experience with most insurance agents are they just give the customer a premium based upon $1,000 deductible. So with my customers that have assets remaining after closing, I say, get a quote at 1,000, 1,500, and 2,500. I said, as individuals, how often have you used your insurance company for claims? And a lot of times it will get them a lower premium. Now, my first-time home buyer that is leaving them $1,000 in the bank, no, I don't want a $2,500 deductible. But I try and get them to ask questions and not just accept the offers like just 1,000. There's some agents that give that quote difference out. But that is something we need to consider because I had a customer I was estimating because they're asking questions. And so they're also looking at other things on their insurance records behind the scenes that I cannot see. And I don't know how it affects the pricing, but I literally had a customer, their insurance that I was using at $90 a month ended up being 176. And I'm guesstimating on what I'm seeing, but now I'm seeing so much more. So just FYI, just try and educate them and when they're asking for quotes to ask for that. And then, so did you know that the single ladies are 19% of home buyers in the market? 19% are single ladies. So I was going to do the Beyonce, intro, all the single ladies, but I didn't think that was appropriate. So you know what my thoughts were. But anyway, only the intro of the song. But 19% are first-time home buyers or home buyers are women now. Now, I would have a customer back in the 80s that came to me about a mortgage. And she literally scared me to death. I mean, I started very young, so a older lady coming in and slapping my desk was kind of frightful in the very beginning. But she said, she goes, can I buy this property? And I said, well, yes, ma'am. And she slapped my desk. She goes, it's about time. I thought I was going to jump out of my skin because it was startling. She said, when I started buying a house, but she was older, she goes, and I divorced my husband. No one wanted to loan me any money. No one even wanted to think about selling me a house and me getting a mortgage. So for me to see it that 19%, I mean, this is some years ago, 40 years ago, that we've come that far and for it to be 19%. And so I just wanted to mention that to you. It was interesting to me. So this is me saying, let's work together. I'd love to educate you. I'd love to be here and sponsor you guys and everything. And I need business as well. So whatever I can do for you guys, I'm here for you. I'd love to work with you. I'd like to be some of one of your top lenders that you at least call. Do we have answers to it all? I don't have all the products. There might be, but we have so many products. And me coming from a background that didn't have all of those products, to be honest, I know what it means, but I'm just trying to see where my flexibility is with a lot of different products. So we are your go-to. We're here to support you. You need any marketing or you want me to do open house flyers. We have this fabulous open house flyer that literally at the bottom of it will give you listings of every house that you have listed. Now, if you're on a team, it's going to give all the listings for that particular team, okay, because of the way it's on MLS. It's used by MLS. The client will be able to see 5 different scenarios. We can work up, they'll have their pictures, it'll have all the neighborhood connections. It'll basically have the MLS website right there on the flyer. And it has a QR code. And if you change the sales price, when they go in on the QR code, it will change it as well. It's supposed to. So I can do all of those things for you. Just get your buyers to me, let me cancel them ahead of time so we have them more ready for you. And then always let me know if they're going to be crossing over from county to county, because with, especially our first-time home buyers, but there are so many programs that aren't labeled first-time home buyer. They don't have to be a first-time home buyer to use these products that we've gone over on the majority of them. So have you found this to be helpful? Is helpful?
Yeah.
Okay, great. And then has it been overwhelming? It's just a lot of information, but I'm sorry. It's just literally trying to introduce it to you that it's come so long When I started, when I got my rate sheet, it was a list, 5 lines. Everything had a rate, an origination fee, no matter what, and here were your points. It didn't matter. It didn't matter the loan amount, it didn't matter the credit score. This was your rate, this was what you could do, and it's like 5 lines. And that was that. Today's world is a different world. But it's good, it's a good thing because it is trying to make it more individual to areas. But it's really shocking that from one area to another, our income limitation, even for Harnett County, I would think Harnett County would be a higher income limitation now, but even there, when we cross over, it changes my loan products for certain products, certain customers. So thanks for allowing me to stumble over words. Like I said, when I get started and I have connection issues, I get nervous for myself. Thank goodness Nicole was here. And that is everything. You guys are welcome for lunch. And if you'll put your business card, I am doing a drawing for an Amazon card, and I will use your email and have it sent to you electronically. And I'll send you my home address. You could go ahead and ship my gift, So anyway, thank you guys. I really appreciate your time.
Thank you.